right, gang, we're back. First recording of the Happy New Year. Coach Roel, grab Scott again. Scott, how were your holidays?
They were fantastic, just the way I like them, and that is very relaxing with family around. Not as much family or as many family members as normal, but always a good time of the year. So it was great. How about yours?
Oh, it was very good. It was nice and chill. It was
Mm-hmm.
warm because we were down here in Florida. Usually we're up in Toronto, but this time we just
Mm-hmm.
stayed put and had a low key with just the immediate family.
Yeah, good for you. Good, good.
So I know we're, as always, squeezing in this little Q&A. So congratulations are in order to us for closing on the Clarksville project.
Yeah, that was good to get that done, and welcome aboard.
Yeah, thanks. I'm excited to see how this goes. Again, as I was saying a couple of times ago, I'm doing my best to practice what we preach here.
Mm-hmm.
So I'm learning by looking over someone else's shoulder, and then also continuing my own marketing to be able to
Mm-hmm.
to get my own facility as well.
Yep,
With
right around the
with
corner.
Yeah, it for sure. It will be this year, 2021, baby.
Mm-hmm.
So with that, I want to ask you some technical questions. Things
Mm-hmm.
like, what is IRR? What is equity multiple,
Mm-hmm.
preferred return? So I kind of
Mm-hmm.
want to give that to you to um, address it with any angle that you want. So
Mm-hmm.
yeah, what are those things? Those are very technical terms for a lot of us.
Mm-hmm. Yep. So, the question comes up a lot of times for folks that are looking to invest passively, like yourself in this project, Roel, and then also for syndicators like myself, when we're putting these projects out in front of the passive investors, our partners that we're bringing along with us. They want to see those benchmarks, and those are the three that are the most common, which is why you got those questions. And so there's two sides to this. One is, well, first of all, what is it? How do you calculate it? And then second of all is, okay, now I've got the calculation. How do I apply it? How do you apply the math, the financial math, or the real estate math? And so, I guess first of all, we are in as syndicators and promoters, we're really in the money business. So we're a financial services company in essence, and we're putting these products out into the marketplace. They are securities, and they are governed by the SEC, the Securities and Exchange Commission. So when we do a syndicated project, we're formulating a PPM, a private placement memorandum with the SEC, and we have our projected returns on these projects, and that is what they're just that. They are projected returns. And in other words, we're going to buy this piece of ground. We're going to develop a facility. Once it begins cash flowing, it's going to produce this much over the course of 4 or 5 years. And then when we sell it or refinance it, we should have this pot of money. And so if we add up our cash flow and the amount of money that we made when we sold it or refinanced it, here's what we have. Now we divide that by 5 years. That gives us an internal rate of return. So there's a difference between a return on investment or overall cash on cash return. But in most of these syndications, these projects where partners are coming alongside of us, like yourself, Roel, you want to see not only how much total money am I going to make, but how long does it take to get there? Because if an investor gives me 50,000 and I give them back their initial 50,000 and another $50,000 on top of that, well, that's fantastic. That's a great rate of return. If it takes 4 years to do that, fantastic. If it takes 10, 15, 20 years to do that, not so good. Now we're looking at bank rates. So, there's a time value of money. And so an investor always wants to see, if I give you this amount of money, how much money are you going to give me back? And in what time frame am I going to receive that all back? So that's why probably the largest benchmark and the calculation that most investors are looking at on the passive side is really that internal rate of return. So what does that look like, and how long am I going to get it back? What is the amount, and how long is it going to take before I get that back? The second that you mentioned is equity multiple, and that's just a straight calculation. So if an investor gives us $50,000, we give them their initial 50 back, and another 50,000 on top of that. That's a 2x multiple. It's 2 times their return. So it's calculated on the principal coming back as well as the additional money. So again, the IRR is totally different because it depends on how much time it took to get that additional $50,000 back. But the equity multiple, it changes and it varies. The IRR and the equity multiple, they don't go in lockstep with one another in an investment, obviously. But there's usually some benchmarks and they're pretty close for the most part in terms of investments that you're looking at that are in a 4 to 5 year range.
So I
And then
just
there's
want to jump in a quick sec
sure.
there. So the biggest differences that I want to point out, or one of the biggest differences, is IRR is totally dependent on the amount of time involved.
Hmm.
Equity
Hmm.
multiple is not dependent upon time whatsoever.
Hmm. That's correct.
Yeah.
So, I mean, in technical terms, internal rate of return, it makes the net present value of all the cash flows over the course of an investment equal to zero as in a discounted cash flow analysis. And so they may be going a little too deep for folks. I think it's easier to just explain the way we did, which is add up the cash flow, add up the amount of money you get at the end, and then divide that by the amount of years that you had into you invested into the project, gives you your internal rate of return. And
Hmm.
equity multiple doesn't matter. It's not dependent upon time, as you mentioned.
Yeah. And then preferred returns. What is that? That sounds
Yeah.
nice.
Well, that is it is nice for our passive investors, and it is also a bear to calculate because there's multiple ways of calculating this. Some of our savvier folks may have heard of waterfalls and different ways to be able to invest money to get a different type or rate of return. But at the end of the day, a preferred rate of return is just that. It means that our investors, our limited partners that come alongside of us that are investing with us in our projects, they get a preferred rate of return, which means that they get paid first because they are in a preferred position. So if we put out a private placement memorandum, an offering, and we're offering our folks an 8% preferred rate of return, it means that when their money is out, we're offering them an 8% return on their money. So out of the gate, it's like a coupon. It's a coupon style of investment. And so being preferred means that they also get paid first, which means, and one of the ways of calculating this, but is the most common, means that once cash flows begin to come in, we pay the investors 8% on their money and they get that first. Then comes the split of the profits and the cash flow. So depending upon how many investors are in, the cash flow is then split and paid out to everybody. And then also the same for the sale of a facility at the end. We make sure that the investors are paid back 8%. They received an 8% return on their money the entire time they had it out. After that, they have been paid. Then we do the calculation for the equity split of what our limited partners receive versus what we receive. That way they get their preferred rate of return.
Hmm.
Hopefully that makes sense. And there's multiple ways that we can explain that real well. There's multiple ways of calculating preferred return in an investment. It could be a pari passu, which means that an investor comes alongside of the syndicator and they get paid at the same time. It's a preferred rate of return, but you're getting paid at the same time instead of the investor getting paid first. Some calculations do not include the 8% going back, but the split stays the same. They just get paid first before any splits are calculated. So again, a number of waterfalls, as we call them, and a number of ways of calculating this. But for the sake of our 10-minute conversation, that's the best way to explain it.
Hmm. Before we get too deep into that rabbit
Mhm.
hole, uh, is there a standard that people should be looking for or that
Mm,
you aim for offering, starting with, again, from the top, from the IRR, equity
yeah.
multiple? What should be people be looking for?
So that's the second piece of this. As I mentioned, it is okay. So what do I do with these calculations in the math? Now that I know how to calculate these, if I'm a passive investor, well, how do I know if a project comes out that I'm considering investing in, and the internal rate of return, their projections for folks like myself is 15%. Well, is that good? I don't know. I think it's good. The banks are only paying what 0.01% on an interest rate, and CDs are at about 2%. So 15 sounds good.
Hmm.
What about 20, 25? Well, we don't know until you go out and look at the marketplace. Like I said, we are in the money business. And so we put these projects out offering a return. It just happens to be backed by self-storage. And it happens to be backed by our company, which is a syndicating company that also we develop and we acquire, we create value, and we own and operate our facilities. And so a reputable company that has produced those same types of returns to their investors, that gives investors some assurance that this is a company that I want to invest with. So if it's in that 15 to 16% range, okay, well, is that good? Perhaps it may be a little lower than other projects out there, but you know what, this company is tried and true and tested. If it's a 30% internal rate of return, some folks may be scratching their head thinking that's kind of high compared to the rest of the market. Are they hiding? Can they really realistically meet those numbers, or are they a new company syndicating for one of their first or second deals and they have to offer higher returns to get people to invest with them to begin with?
Hmm.
So, having a history of going out and looking at multiple types of projects across the landscape, whether it's apartments, self-storage, assisted living, hotels, in today's interest rate, it's really market driven. Most of these projects that are existing value add are in about a 19 to 20% internal rate of return. And the more riskier projects that are development or conversion that take a while to cash flow and then to sell, they're in the mid 20s in terms of an internal rate of return. And again, the equity multiple, that really depends upon the project and how it's structured. And then the preferred return, that is really up to the syndicator or promoter as to what they're going to offer in order for people to feel comfortable and invest with them. So the preferred return is kind of an enticement. It's a little cherry on top to get people to invest with them outside of the IRR and the equity multiple. Does that make sense?
Yeah, one thing that I really want to latch onto is the fact that you had mentioned, has the promoter consistently been able to deliver on these types of targets in the past? And that's definitely a case of the projects that you've been involved in, right?
Yep, it is, and so it's real easy for someone to syndicate and put together some projects where they raise capital, but the proof's in the pudding. You know, have they bought or developed, created value, and then sold and produced those returns to their investors, compared to the what the projections were at the beginning of the investment. You know, did they hit their marks? Did they under promise and over deliver, or did they over promise and under deliver? And that is the true mark of whether you should invest with someone or not.
And so how can people actually, like, let's kind of wipe the slate clean.
Sure.
And you are notoriously a fast speaker, a talker, and I know you had mentioned in a previous one that people can go to investopedia.com and get all the theory in text form. But one of the things I like about what you talk about is intentional coaching, intentional support. So wipe the slate clean. Somebody's viewing this video and they're like, wow, I love the concept. I get the idea. It's steel doors on concrete, as you say, but I want to get into the nitty gritty.
Yep.
How can somebody get started from scratch?
Yeah, well, so that's at least on this side, that is one of the first things that we teach. As a matter of fact, when people begin working with us in our mentoring programs and our top programs, we have the financial mentoring group, which you're familiar with, Roel. It's probably the best place to start because it's pretty intensive. We go through for 5 weeks, sometimes 6, so that people feel comfortable underwriting a facility and understanding what a P&L looks like and how to properly underwrite and evaluate a facility. But then we take it a step further, and if we are bringing in private equity for ourselves, we're calculating an internal rate of return on our own money and our time and capital into a project and looking at equity multiples. But more importantly, for syndication purposes, or just bringing in a partner to be able to properly structure and take the splits that are appropriate in a project and apply them into the marketplace that'll attract private equity or partners, given the rates of return that are out there, and how to go about doing that and making sure that you're doing it correctly. So our financial mentoring group, that is, it's a standalone class. It's the first 5 to 6 weeks of our mentoring class. So, if folks are interested in that, they can go to selfstorageinvesting.com and you can click on the products to find out more about the financial mentoring group and how to go about learning the best ways to do this and really understanding this piece if you want to, peel back the onion and dig a little bit closer. But in terms of the norms, which I think is the second part of your question, Roel, which is, okay, what is the market bearing right now? I mentioned 19, 20% for existing facilities, and in terms of an IRR, and then mid 20% in a development project is what we offer to our other investors in those types of projects. Well, look around the landscape, look around the market. Our site, passivestorageinvesting.com, that shows our current and past projects that we have done, that we have funded. And you can see over the course of time, it is interest rate sensitive, and depending upon where the market's at is on the types of rates of return that we're going to offer to our investors. And some of them maybe seem a little bit low, but at the time they may have been higher than anything else in the marketplace. And that's really what we try to do, is to be attractive. We want people to invest with us, so that they get a good return and not go somewhere else, and know that we have the history and the wherewithal. We got over 2.2 million square feet of self-storage, 13,000 doors, and been doing it for 21 years now. So we are a solid syndicator and promoter that gives people assurance that we're a company to work with. So do your homework on the side of doing the calculations, but we do provide that mentoring for folks. And when we get into these more detailed calculations, it takes a little while for those to sink in, and then learn how to apply them for your project. And that's what we show you how to do. Because as you mentioned, anybody can go to Investopedia find the definition and the calculation, but there's multiple ways of doing it. And then how do you apply it? And that's what we teach. And then to see it, how we've applied it, you can go to passivestorageinvesting.com to get a sense of the types of projects that we're putting out.
That's awesome. You know, I got to comment again. What's really, really exciting about being part of the organization with you is that you're out there actually doing it. A lot of people always wonder, oh, there's another make money education class of some sort. But I need to point out to people as well is that you're out there actually doing it with oftentimes alumni students that started right from scratch, like many of the people watching this video. And then there's also that educational side. So it's like real life, what you're doing out there in the real world is actually being brought into the virtual classrooms as well.
Yep. Well, we walk the talk, and that's how our education stays fresh, and that's how we create more partnerships and keep sharpening the business, because we're in it day in and day out.
That's awesome. Okay, so for this week, thank you very much, Scott. I'm sure you probably got many other appointments for today.
A few.
So it's good seeing you, and here's 2021.
All right, happy 2021. Thanks.
All right, all the best. Thanks again for joining us here at Self-Storage Investing. We really, really appreciate it. For more great content like this, make sure to click the subscribe button below this video. And be sure to follow us on Facebook, Instagram, Twitter, LinkedIn, and Bigger Pockets. You can also visit us at our main website at selfstorageinvesting.com, where you'll find even more free content, our ebook, and registration to our free webinars and education courses, and much, much more. Once again, for more great content like this, please click the subscribe button below. Thank you.